Welcome to the August monthly market report. It's always so good to come together every month and talk about exactly what's happening in this market. We've got a lot going on right now. At the time that I'm recording this, it is, I think, the 5th of August. We're seeing a lot of volatility in mortgage rates. I'm going to cover that. We're going to talk about home prices. And then we're going to wrap up and we're going to talk about something that, is a byproduct of this market, and that's equity and sort of the impact of capital gains across the country. It's very, very interesting. So with that as a backdrop, let's hop into the August monthly market report. All right, I'm going to start out the way that we do each time and remind you that most agents, even when we're talking about mortgage rates, like I mentioned, know what's happening. The good ones understand it, but only the great agents can explain what's happening. And my hope over the next 20 or 25 minutes is that I give you information that helps you explain what's happening in this market. Maybe it's somebody that's thinking about buying or selling a home. Maybe it's your team. Maybe it's just an interaction that we can explain what is happening in this market so that people can make the best decisions for them and their family. All right, so we're going to talk about mortgage rates dropping. It's probably the biggest story as we sit here in August, and I believe we'll continue on as we go throughout the fall. And my hope is for the next few minutes that we can kind of unpack where we've been, where we're at right now, but more importantly, what's ahead. So all of this comes on the heels of the Fed meeting on July 31st, where they decided to maintain the target rate for the Fed funds rate between 5.25%, 5.5%. That is not the mortgage rate. That's the Fed funds rate, but certainly a lot of eyes on the Fed right now saying, what are you going to do? And like I've always said, the indication that the Fed is taking action or lowering the Fed funds rate will be an indication that we are getting through some of the issues that we faced in this economy, and we certainly want to see that. Mark Zandi said it very, very well. He said this: the Federal Reserve stuck to the script, holding monetary policy unchanged, but strongly suggested a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. And global investors are cheered by this. Stocks are up and a lot of bond yields are down, as they should be. The economy is set to soft land. Now, this was written by Mark, on the heels of the Fed meeting. And now we where I sit today on the 5th, we're seeing markets sort of respond to that and be down right now. We'll see how this plays out over the next several days, but no doubt a shift economically speaking in this country. Reuters just did a poll, and most economists, as of a couple of weeks ago, believe the Fed would cut rates 2 times this year. That could lead to maybe 3. I don't know. We'll see what happens there, but there certainly is sort of this different temperature. The Fed came out and said, hey, we're likely to cut rates in September, and pointing that direction. Sam Cater said this: mortgage rates declined to their lowest level since February. Expectations of a Fed rate cut coupled with signs of cooling inflation bode well for the market. But apprehension in consumer confidence may prevent an immediate uptick, that's in home sales, as affordability challenges remain top of mind. Despite this, a recent moderation in home price growth and increases in housing inventory are a welcome sign for potential home buyers. So no doubt we want to see rates come down. They're coming down, one part by the Fed's action. The other piece is unemployment. That weighs into it as well. The unemployment rate rose by 0.2 percentage points to 4.3% in July. And the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year earlier when the jobless rate was 3.5%. The number of unemployed people is 5.9. So you see the Fed saying, hey, we're likely to make a cut. You're seeing, unemployment start to rise slightly. And here's a look at that, sort of a graphic look at unemployment. You see on the left there, the red bars, the time during COVID when unemployment shot up, and it's come down and sort of been plateaued there below 4%. Now we're starting to creep up ever so slightly in unemployment, and maybe the Fed feeling like they need to take action. Lawrence Yun said this: mortgage rates are plunging on the news of weak job growth and rising unemployment. And I would add to that, because of what the Fed's action and what they've said they're going to do. Now, one thing is true about all this information, it could change at any moment, but we want to be able to guide our clients forward confidently. So how do you do that in this market? Well, I think you stick with the facts of what is happening. And as we stand here today, as I'm recording this, the average 30-year fixed is right at 6.4%, according to Mortgage News Daily. And you see it right here from really April, the end of April this year till today, going from about 7.5%, just over 7.5% down to 6.4%, more of a drop of 1 percentage point, which bodes well for affordability, means more people that were on the sidelines that couldn't buy a home can now buy a home. It's ultimately a good thing. Our team put together a great slide. We've got so many great KCM resources to help you show people what this means. But here's an example. If you go back to January 2024 and you were to borrow $500,000, just a round number, if you're in a market that's maybe half of that, you could do the math in half. If you're in a market that's double or some multiple of that, you could do the math there. But $500,000 borrowed in April, mortgage payment just over $3,500. You see it right there. Well, today, $500,000 borrowed at 6.4% on the average 30-year fixed, a little over $3,100, a savings of $357 over the last several months. That is good news for those that are thinking about buying. Now, I'm not here to say we're going to see this rush of people come in, but more people will. More people will make a decision. We talked in the monthly market report about the number of people last year that abandoned their search based on mortgage rates, really based on price and cost, right? They couldn't afford to do what they wanted to do. Lawrence Yun said this: there's a large pent-up stored demand that could be released into the marketplace when conditions improve, lower mortgage rates and more inventory. And what? Inventory is finally turning up about 15%. And that is likely a leading indicator that we may finally see more home sales as conditions improve. We're seeing mortgage rates come down. You're seeing inventory rising, means more choices. And that is something that many home buyers didn't have over the last couple of years. Doug Duncan said the same. Listings have trended generally upward as of late, suggesting that a rising number of current homeowners can no longer put off moving. So I think we're starting to see the beginnings of this turn in the market. We're starting to see the beginnings of what could be ahead for the next year. Now, again, I'm not here saying I think we're going to overnight see a ton more demand coming out. Not saying that at all, but I do think we'll see more. We'll see more people make a decision to say now is the time that we want to do something. Greg McBride at Bankrate always does such a good job. He says the hopes for lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. Mortgage rates are 7% now when he wrote it. And the best we may be able to hope for over the next year is 5.5% to 6%. I certainly think in the next year that is on the table, right? If we're at 6.4%, we go through the year, maybe there's challenging economic data that comes out, that old saying that bad news in the economy is good news for mortgage rates. And we may see that out there. And so we're going to continue to keep an eye on this and watch for it. But the question really is, what's ahead? I'll give you one piece from Bill McBride where he quotes Goldman Sachs, because I'm going to talk in just a minute about home prices. And I think all of this is sort of creating this picture for, should I buy right now? Should I sell? What's going to happen to home prices? What's going to happen in this market? Bill McBride says we expect consecutive 25 basis point rate cuts in September, November, and December. The slowdown in job growth in the July report likely overstates the decline in the underlying trend. But if the August unemployment report is also weak, then a 50 basis point cut would become likely. So I think right now, as we look forward, what can we say that experts are saying? One, that it's likely that the Fed is going to cut rates in September. That's the odds-on favorite for Wall Street right now. And I think there's a further likelihood that they could cut rates several times, 2, maybe 3 times this year. That's going to bode well and better for mortgage rates. That is a good thing for affordability, right? And what's that going to impact? I would make the case that that's going to impact home prices. Over the last several weeks, we've seen, maybe news articles that say, is a price correction coming? Are home prices going to fall? Here are the top 15 markets that prices are going to fall. Now, this is certainly going to be determined by the area of the country that you're in, the price point that you're in, what happens with prices. But I will say this, I believe as mortgage rates come down, it's going to keep upward pressure on prices. And maybe in a more normalized or moderate environment is what we'll see in prices, but not this situation where we see prices falling. And I'll give you the latest forecast and even a peek into what experts are saying about next year, 2025. Experts forecast lean towards a moderation in home prices over the next 5 years. This translates into a slower and more sustainable pace of appreciation compared to the breakneck speed witnessed in recent years, rather than a free fall in prices. Now, let me be very, very clear. I don't see anybody right now, maybe somebody on YouTube, but anybody calling for nationally home prices to come down. Matter of fact, this is the latest look of where these forecasters believe we will wrap up 2024. If you were to ask me, the average of all 7 of these forecasters, 3.1% in residential home price appreciation, will probably end up somewhere between 3 and 5%. Again, mortgage rates, we get a little relief, might see a little uptick in home price appreciation. So that's the look at national home price appreciation. Again, not people calling for this correction in home prices like has been said, but let me give you what the first look at 2025 home price forecast. You see it right here, very similar to what's being forecasted for this. 2.7%, the average of all of these forecasters. So as we look ahead, maybe people wondering, are prices going to come down, or there's no way that home is worth that, or there's no way this market continues on? Well, certainly those that follow it, the experts that we follow, are saying differently than that. But a more normal rate of price appreciation. Lance Lambert, probably one of the premier experts on pricing, says even if the average national home price forecast for 2025 is correct, it's possible that some regional housing markets could see mild home price declines, while some markets could still see elevated appreciation. That has been, after all, the case this year. I think nationally we'll see home prices continue to appreciate. I think also there will be markets where things will, maybe by price point or location or whatever the case is, we'll have maybe a plateauing, maybe even some softening in prices. Our job right now is to understand the national economy relative to real estate, but also be the local expert when it comes to prices. Rising prices lead to one thing for every homeowner, which has sort of been the silver lining over the last couple of years, and that's equity. Now that leads to capital gains in a lot of cases. I want to give you sort of a quick look at what's happening across the country with equity and with capital gains. And I think it's something that we need to make those sellers aware of that could be facing this. But here's a great slide from the St. Louis Fed that our team was able to pull that goes all the way back to 2000, shows equity, mortgage liability, and real estate value. And I want to park here for just a moment. What do you see in green there? Just over $45 trillion in real estate in this country. The blue bar there, $32 trillion in equity on that 45 in value. And what do you see down here? About 13 million in mortgage liability. This slide just shows so well the underlying strength of today's real estate market. A lot of value, a lot of equity, and relatively low liability. If you look at that liability line, it's come up a little bit, but certainly not where we were in 08, 09, 2010, where there was literally more owned on homes than there was equity. And I think there's a message in that. That equity is the strength of every homeowner, and certainly has been the case with the rapid rise in home prices over the last several years. Realtor.com said this: for decades, few homes appreciated enough in value between purchase and sale to exceed the $500,000 exemption cap. But a recent report from CoreLogic found that last year, 229,600 homes sold in the US, or 7.9% of all transactions, had a gross capital gain above 500,000, potentially triggering tax liability. That's up from an annual share of 1.3% 20 years ago. So single is 250,000, married 500,000 gain, where you then trigger capital gains tax. Seeing a lot more of that, and that makes sense, right? With homes selling for more, homes selling above, sort of this astronomical rise in home prices over the last several years, really unhealthy rise in prices, ends up causing this. And here's a look at it, going all the way back to early 2000s to where we've been last year, 7.9, call it right at 8% of transactions, sort of tipping into this point. Now, I think the good news about equity is you have all that equity, and you have to deal with this as a byproduct. That's not a bad thing for most sellers, but they do need to be educated on it. Maybe somebody that's just going to tip into that needs to understand it, and folks and that's on anything above 500,000, but something to be aware of, something to remind people about, and certainly is a byproduct of the rise in home prices. Danielle Hale said this: for most homeowners, the capital gains exclusion, which allows you to pocket the first 250 or 500,000 if you're married, and the gain on the sale of your home without having to pay taxes on them, means that you're not likely to pay taxes on the proceeds from your home sale. But homeowners who have lived in their home a long time or have seen substantial home gains should be aware of the potential impact. I think this is a topic that we can be educators on. And depending on the state that you're in, this is a look by state, sort of the darker the color, the higher percent of transactions that have been, subject to these capital gains taxes. You see California and Washington, and up in New England, several states that have higher than maybe the rest of the country in the capital gains transactions. So something based on where you're at, based on where you're watching the monthly market report from, you want to be educated on so that you can be the educator to the clients that you serve. NerdWallet said this: navigating the tax rules of selling real estate or an investment property can be complex. Long or short-term capital gains will apply upon sale depending on how long you own the house. But there are also ways to minimize or defer taxes on these types of properties. Consider speaking with a tax advisor or financial advisor to learn more. This is a good point here. I would encourage you, as this is a topic, to connect with tax advisors, connect with those that are talking to people about what they're doing with housing. Certainly can be something that can help you grow your business during this time. Odetta Cushy said this: while housing affordability is low for potential first-time home buyers, slowing price appreciation and lower mortgage rates could help. So the dream of homeownership isn't boarded up just yet. Odetta does such a good job of articulating what's happening in this market, and she's done it as well right here. The aim of the monthly market report is to give you everything you need to stay on top of what's happening, but also be able to explain it. We started off and we said only the great agents in this country can explain what's happening. And that's certainly true today. I want to wrap up this time, and I had a quote here that I wanted to share with you. And I think it's very, very appropriate for where we sit. A lot of volatility in the market right now. We've seen a year where we've seen less transactions than what we expected. And we are forging ahead and giving you everything that we want you to have to be the educator. But the old Jim Rohn quote is right here: don't wish it were easier, wish you were better. Don't wish for fewer problems, wish for more skills. Don't wish for less change. Wish for more wisdom. Let's get better. Let's gain more skills. And let's get the wisdom. Let's get the information. Because if we have that, we can then guide clients forward effectively. Listen, it's always a pleasure to get to be with you on the monthly market report. And our aim is always to give you the education you need to be the trusted advisor for the clients you serve. And we'll see you back again next month. Take care.